Hi everybody, this is Peter Schiff. This is Tuesday, October 13th, 2009. As you can see, I am recording this video blog from Hawaii. I've been here for the past few days. I spoke at a conference. I'm leaving in a couple of days for Chicago. I speak at another conference there, a Hispanic organization. And then I have a Euro-Pacific Capital client meeting. We have over 700 people already signed up, so if you happen to live in the Chicago area and you want to come by my function, check the Europac website for the time and location. You can still sign up. I'm also going to be autographing some copies of Crash Proof 2.0. There's a bookstore that's going to be there selling books. Also, when I get to Chicago, I've got an appointment to tour the Chicago Merc on the floor there with CNBC's Rick Santelli. They're trying to do a live hit for me on CNBC with Rick. It should be very interesting. I'm sure I got a lot of fans down there on the floor. And I know Rick Santelli, as far as all of the personalities, on-air personalities on CNBC, Rick is the one guy that really seems to understand what's going on in the economy and doesn't mind voicing his opinions and arguing with a lot of the other anchors and guests that appear on that program. Now, speaking about the problems with the U.S. economy, we got a report the other day that showed that the share of consumption as part of GDP has actually risen during this recession. It's now at 71% of GDP. This is a record, or at least a record going back to the Second World War. This shows we're still going in the wrong direction. We haven't addressed the underlying economic imbalances that are the cause of the recession. You know, by the time this recession really bottoms out, I'm sure that consumer spending is going to contract somewhere to around 50% of GDP, which would be far more normal than the 71% that exists today. But instead of allowing the necessary correction, the government is interfering with that. You know, even, as I said, even at this G20 meeting we had in Chicago, President Obama was saying Americans need to spend more. I mean, need to save more and spend less. We need to produce more. Yet the numbers show that the opposite is still occurring. And this is happening because the government is interfering with the free markets, trying to restore order to our economy. It is exacerbating the economic imbalances for short-term political expediency, but they're sacrificing the long-term health of the U.S. economy, because the more we're going in the wrong direction, the more difficult it's going to be to turn around and go in the right direction. Let's look at the markets today. Again, you know, it's sounding like a broken record, but gold made a new all-time record high today. Again, the media likes to point out that it's only a nominal high, which is true. Gold would have to be well north of $2,000 an ounce to be an inflation-adjusted high. I'm sure it's going to get there soon, maybe as soon as next year. But it's interesting that the media never makes this comparison with respect to the stock market. You know, when the Dow hit a nominal new high above 14,000 last year, nobody in the media other than me pointed out that adjusted for inflation, the market was still well below where it was in 2000. Also, the U.S. dollar index hit a new low for the year today. The cash index and the front month futures contracts closed below 76. This is the lowest close and a new 52-week low print for the dollar index. And if you look at the news that just came out regarding foreign central banks and the compilation of their reserves, as far as new purchases go, when central banks are expanding their reserves, only about 1/3 of the new purchases went into U.S. dollars. The majority of the other 2/3 went into Japanese yen and euros. Now, about 10 years ago, it was 2/3 dollars, 1/3 everything else. This has been gradually deteriorating. This is now the lowest percentage of reserves moving into dollars. Now, while this shows that foreign central banks aren't selling dollars yet, they're certainly buying far fewer of them than they used to. And this is how, you know, the problem begins, because we're selling a lot more dollars than we used to, and if central banks aren't buying them, the price is going to go down, and of course buying euros and yens pushes up those exchange rates. Also, if they're buying fewer dollars, well, obviously they don't need to buy as many U.S. treasuries, because they don't have the dollars that they need to invest them in. So they're not recycling them, so they're not propping up our economy as much, and they're not going to be funding the massive deficits that are being racked up in Washington to pay for the bailouts, to pay for the stimulus, to pay for the new health care plan that they're voting on today. Now, of course, as far as I'm concerned, the best thing that can happen to Americans is that foreigners stop lending our government money, because we're obligated to pay it back with interest. And, of course, the government is using that money to expand its power and its influence and diminish our economy and undermine our Constitution. But unfortunately, what our politicians are going to do, if they can't borrow the money, They're just going to go to Penn Bernanke to print the money, and that's what gold is showing. That's what the dollar index is showing. Everybody is bracing for massive inflation, massive dollar devaluation, as the U.S. government looks to print our way out of one crisis right into a far bigger crisis. Anyway, on that happy note, let me just sign off. I will try to blog again between now and my Chicago trip. So everybody have a great week, and I'll be back soon and hopefully see many of you in Chicago.